For the third quarter of this year, 2024, Mansa-X actually had the second best performance this year, and it's already been a good year. So we are very pleased to still have a return that actually beat our estimates. If you look at the Kenya shilling return for the third quarter, we returned 5.14%, which compares to 4.99 for the second quarter this year. So that's an improved performance in the Kenya shilling fund. The dollar fund returned 3.12% in Q3 compared to 2.93 in Q2. So Q3 return for both Kenya shilling fund and the dollar fund was actually much better than Q2 and compares very well with the first quarter performance, which still is the highest performance we've seen this year. Just to put it in perspective, that brings your 9-month annualized return for the Kenya shilling fund to 21% net of our fees. And for the dollar fund, the return is actually 12.71%, again, net of fees. So we're very pleased with this performance, and it continues to highlight that Mansa-X has done very well for the year 2024. For the third quarter of this year, if you remember, recall our last YouTube recording like this, we predicted that there'll be a lot more volatility in Q3. For every month of quarter three, we had something that was interesting enough to create volatility in markets and to create opportunities as well for trading markets. We had events in July, August, and September, each of which were actually uniquely different and contributed to a very interesting quarter overall. Beginning in July, of course, the first thing that we noticed was, as market participants and investors, there was great disappointment that the Fed did not actually, reduce interest rates in their July meeting as was expected. So that actually shocked markets quite a bit, and came as a big surprise. They retained interest rates as where they were, and markets had expected a rate cut, especially on the back of reducing inflation numbers. So that was quite surprising. And then politically, of course, one of the biggest events in July was seeing Kamala Harris, run for president and Biden stepping down, creating a very tense political environment that we continue to see up to now in the lead up to the US elections, because she created a lot more excitement amongst the Democrats that they had a better candidate to run against Donald Trump. Then towards the end of July, one very interesting thing happened, which is the Bank of Japan actually increasing interest rates. For a very long time, the Japanese interest rates have been at zero or negative in terms of numbers, and this has made it a very interesting currency to borrow against, to then convert to dollars and invest in dollar-denominated assets. This is called a yen carry trade. And the impact of this is that if you increase yen interest rates, then what happens is that investors who had borrowed the yen to invest in dollar assets then start getting out of that position by selling their dollar-denominated assets to pay back their loans that are yen-denominated. This is called it's called an unwinding of the yen carry trade, and this spilled over into September. So the unwinding of the yen carry trade spilled over into the beginning of August, where we saw a very serious unwinding of dollar-denominated assets. And there's also another reason for this, because with expectations that the Fed would actually also cut rates, investors were a lot more anxious, and there was a lot more urgency to exit dollar-denominated assets. So at the beginning of August, we actually saw a drastic drop in the S&P 500, one of the biggest we've seen in a long time, about a 5% drop in less than 2 days as investors fled dollar-denominated assets. So this explains why the beginning of August was actually quite a scary moment for investors who are long U.S. markets and dollar-denominated assets, and this is entirely mostly due to the yen unwinding of the carry trade. One of the things, however, that's very important to note is that immediately after this unwinding of the yen carry trade and the impact on markets, the negative impact on markets, the markets recovered almost immediately to not only recover the losses, but again continue on the upward trajectory. Again, these are some of the reasons we usually insist that it's very difficult to actually time markets, and you should really just put time in markets, and this is a very good demonstration that you can have a downward move of 5% in 2 days and still recover everything within the next 1 week, almost like nothing happened. So this was very interesting to see in August, making it a very interesting trading month. From a global perspective, in September, we saw the Fed finally lower interest rates by 50 basis points, the much awaited interest rate reduction. I mean, we are finally down to 4.83 from 5.33, which has been the consistent Fed rate for the last 1 year. Yeah, and for that reason, we suddenly markets again continue to be very optimistic in September. From a geopolitical tension perspective, we saw Israel again. The tensions between Israel and Lebanon create some sort of tension again in the markets. But this is something that has almost become the norm. But we continue to be very sensitive about its impact on markets. So essentially for September, the rate cut became the biggest theme in markets. And if you look at Q3, one of the things that has been one of the biggest criticisms this year for the stock market was that the Magnificent Seven were performing better than the S&P 500, meaning that a lot of cynics felt that in reality, markets are not doing too well. It was really just 7 companies, the Magnificent Seven. We are talking about Meta, Alphabet, Amazon, Nvidia, Tesla, the 7 major tech companies. For a long time, the cynics felt that these were really the companies holding up the stock market. But in Q3 of this year, there was a very healthy rotation, where now suddenly the companies that did very well tended to be utility companies, healthcare companies, and real estate companies suddenly, and even small cap companies. Now suddenly these companies actually did better in Q3, and in fact the Magnificent Seven actually trailed the S&P 500. We feel that this is a very healthy rotation, and also was good proof that the market is reasonably resilient in spite of the overweighting of the index to these 7 companies. So that again is something that gave market investors a lot of confidence in Q3, and as we close Q3, we go with that confidence into the close of the year. Locally, it's also been an interesting quarter. Of course, the biggest thing for Q3 locally has been the fact that there's a rejection of the finance bill. Now, the effect of this is creating anxiety amongst investors on how the government would handle its obligations. Of course, one of the biggest obligations being their debt repayment obligations. So based on this, we saw yields spike both for local debt and our Eurobond portfolio because of these anxieties from investors. But in August, the central bank cut interest rates by 25 basis points from 13% to 12.75, which again started signaling to markets that we might actually flip to an era of low interest rates. And based on these, yields then started trending lower. And we believe that this trend will actually continue and spill over into Q4. And we also saw, we saw the market again have renewed confidence in markets, because in spite of what we were seeing with the rejection of the finance bill, the central bank kept a very disciplined approach in their in their raising of debt from the local markets. In fact, we saw significant rejections of high interest rates from market participants. So we expect that this will keep yields depressed towards the end of the year. From a currency perspective, the Kenya shilling remained very steady, around 130 against the dollar for much of Q3. These are most steady we've actually seen the currency trade for essentially for more than 2 years. And this again signals to investors, both local and foreign, that this is a market that can be dependable on in terms of accessing your returns without the foreign exchange depreciation wiping out your returns. So again, this helped to create a rally in the NSE, especially for banking stocks, where we saw stocks like KCB and Equity stock prices actually go up. We also saw significant price gains in stocks like Bamburi, which we remain very significant players in. And this was obviously very exciting for us and created a very robust local market in terms of making returns, both from a fixed income perspective as yields kept coming off, and also from investing in the stock market. So now we can go through the fact sheet. This fact sheet is distributed to all our investors at the end of every quarter. It's a very comprehensive document. It's a document that describes the fund, gives you a description of what asset classes that we invest in. And it's very important that you also read the fund manager comments in the fact sheet, because it gives you a general feel of how the quarter was and the expectation we have moving forward for the fund. We also give you a fund overview on the first page, which gives the information around how much we are managing. At the end of Q3, for the Kenya Shilling Fund, we were managing 32.3 billion shillings. And for the dollar fund, we were managing $47.3 million. If you convert that at a rate of about 130, then the amalgamated assets under management is about 38.5 billion shillings. So we give you all the information on the first page, including who our trustees are, Kingsland Court trustees, our regulators, who is CMA, our custodians, who are I&M Bank, and our auditors, who are Charterfy LLP. It's very important for investors to be going through this document. Over and above this fact sheet that we share with our investors, there's also another document that gives you a detailed overview of the Q3 performance from all the markets that we trade in. And we also give you an outlook of what we expect the outlook to be as we close the year. So for investors who are very curious about markets and really want to understand everything in detail, please go through these documents and give us feedback as we continue to improve information that we disseminate to our investors. Over to the top 10 holdings. So our top holding was fixed income instruments. That's for the Kenya Shilling Fund. And in this regard, we are talking about Eurobonds. If you remember, in Q2, we mentioned that we were expecting yields will start coming off in the second half of the year as central bankers around the world start cutting interest rates. We believed that the US would start cutting interest rates, and they did, as they did in September. And we felt that other central bankers would actually follow suit. So we were mostly invested. The biggest holdings we have are Eurobonds, but we also hold US Treasuries, German bonds, and so on around the world. And this remained our top 10 holding, just like it was for Q2. Our second holding is actually more of a hedging play. We have interest rate derivatives, contracts that we hold, like futures and options on short-term interest rate instruments. We use this to hedge our exposure in these fixed income instruments in the book to prevent, to protect ourselves from any downside moves. And that's why it also, it follows and tracks our fixed income instrument holdings. S&P 500, obviously, because we expected the market to remain elevated, which it did, about a 5% move in the S&P in Q3. We were also holding gold, and this actually jumped about 13% for the third quarter of this year. Meta platforms, about 14% up for Q3. Apple Inc., 10% up for Q3. The Southern Company, remember I had mentioned that one of the interesting things we saw in Q3 was actually utility companies performing even better than the S&P 500 and even better than what we've usually seen in the recent past, where the Magnificent Sevens were the biggest performers. So now suddenly we had utility companies like the Southern Company actually do very well, returning 16% for just Q3 alone. Welltower, a real estate company, was actually the top performer in our book, almost 23% performance for Q3. Then for Bamburi Cement is actually one of the local stocks that we were very keen on, very excited to hold, and we were greatly rewarded. In fact, Bamburi Cement almost doubled in value in Q3 on account of a special dividend on the sale of Hima Cement last year, and also because generally the takeover that is anticipated, and it's very well known in the news that Amilson of Tanzania are looking to take over Bamburi Cement. Then in Q3 also we had an announcement that Savannah Clinker, another company, again had put in a bid to buy Bamburi Cement. This is one of the stocks we had been holding for some time and returned a very good, doubled in value for our investors, and we're very happy about that. So that the Kenya Shilling Fund therefore had a mixture of fixed income instruments, global stocks, local stocks, and cash. They were mostly long positions on account of the fact that we expected lower interest rates will lead to a bullish market, both for bonds, and also we expected stocks to be very elevated for that period. For the dollar fund, the top 10 holdings are fairly similar, with fixed income instruments and interest rate derivatives are the top two. Nasdaq, although did not gain as much, only about 1.6% for Q3, but it was one of our top 10 holdings. Gold as well. General Dynamics Corporation. This is actually a bet on continued geopolitical tensions. This was up 4%. Broadcom, one of the stocks that we actually own as we bet on continuous growth of chip-making companies. This was up 7%. Eli Lilly, one of the companies that we hold in the healthcare sector, actually lost 2%. It was actually it was a much lower performance for Eli Lilly in Q3. Meta Platforms and Walmart were both up about 14 to 19% in Q3. So the dollar fund and the Kenya Shilling Fund, mirrored each other in some ways. The only thing you'll note for the dollar fund, it did not really benefit from local stocks because we were mostly preferring to invest in dollar-denominated assets for the dollar fund. So our expectation towards the end of the year for Q4 is actually a continuation of the theme that we've seen this year, especially what has been solidified in Q3, that we expect rate cuts to actually continue. A rate cutting environment from central banks around the world is expected to continue. In fact, towards the end of Q3 and into Q4, we saw the Chinese policymakers actually announce an economic stimulus. And in fact, already for Q4, we've seen Asian stock markets really perform well. For more than 5 days, they were on a bullish run. And we expect that this will be the theme for Q4 as central bankers race towards who cuts the most as we trend towards the close of the year. Around the world, inflation has been pretty much managed. If you look at US inflation numbers, very close to the Fed target rate of 2%. We are now at 2.4%. So we expect a further rate cut this quarter as well. And it will be interesting to see how this will affect yields, especially for US Treasuries and fixed income instruments across the board. Of course, the biggest conversation and where a lot of volatility is expected to come from for Q4 is really around political matters. If you look at the US, we expect that there will be a lot more volatility before the US elections. The only comfort we can give our investors is that the markets and the economy is much larger than the US elections, and it has become increasingly irrelevant to markets. You can have short-term volatilities that can affect markets, but long-term, you find that markets remain resilient. So we won't be really basing our entire strategy or even a significant portion of it on the outcome of these elections, really just managing short-term volatility for the sake of optimum portfolio performance. Geopolitical tensions, again, these again will be expected to continue to affect markets, and in fact this could affect markets a lot more because tensions around how Israel reacts to the crisis around the conflict with Iran and all the allies that are against Israel and their reaction to each other. This might actually affect the global economy more. We're talking about the prices of oil, natural gas, which again can then affect inflation numbers and probably therefore affect policy making. So this is actually what we'll be watching even more, and that might really be the wild card for the fourth quarter of this year. Yields, we expect yields to continue being lower. Outside of concerns about what I've just mentioned, we expect yields to continue to reduce, and for this reason, we'll really continue to be very present and active in participating in fixed income markets. Locally, the theme is very similar. We expect that yields will actually also trend lower. In fact, we believe the yields have topped out. And we expect that interest rates locally will start dropping drastically. We also expect that the yield curve will normalize. We've had an inverted yield curve for a while now, and in fact, this has actually mirrored an inverted yield curve globally as well. We have seen the global one start to normalize, and we actually also believe that the local one will actually also normalize as well. So this should be a very interesting Q4 for fixed income traders, and that we will also be watching very closely. We will also expect the currency to remain well supported around the 130 levels. From the stock market perspective, locally we expect that bank stocks should do relatively well. With interest rates coming off, this creates a very good environment for banks to thrive, and therefore will remain very bullish on banking stocks. So generally for locally, we are coming off of yields will mirror what we are seeing globally, and therefore not much of a difference with what we'll see locally. Maybe just to mention Eurobonds, we expect that Eurobond prices will remain elevated. We had seen a bit of risk-off in Q3 that had affected Eurobond prices, and I mentioned this earlier as a result of anxieties around the rejection of the finance bill and so on. We believe that this should normalize in Q4. Maybe the only blip that might happen there is maybe the US elections creating some sort of risk-off mood for emerging market papers, but we believe that especially for the short-term papers, which have very good coupons, we expect that a lot of them will actually trade at parity or even at a premium. And this we expect to be actualized within the next 2 to 3 months. In conclusion, as usual, I really want to thank the investors of Mansa-X for continuously believing in us, continuously being part of this journey. One of the things I'd want to emphasize is if there's any feedback that you have for us, kindly reach out to us so that we can continue to improve not just our offering, but the communication of the product that we offer you. One of the things that our investors have asked us for a long time is that they wanted us to have a presence in Mombasa, and we have finally answered you. Now we have opened an office in Mombasa. We believe the office should be up and running by the end of this quarter. It will be located at Nyali Center, and we are looking forward to serving our Mombasa clients because we noticed that a lot of investors from Mombasa were struggling to have to access us here in Nairobi, and we are looking forward to being on location in Mombasa. So thank you very much, Mombasa investors, for that feedback. And this is the kind of feedback that we believe will continuously enhance the value of Mansa-X. We believe that our investment strategy has been proven over time, and we believe that this is something that our investors have continuously seen value from. The biggest value proposition for us is that investment in various asset classes and being very well diversified will typically always beat any other type of investment. And there's no need for investors to go through the hassles of trying to invest in the US stock markets, UK stock markets, different fixed income instruments, investing in real estate and all those, when you can simply come to Mansa-X. We do all the heavy lifting for you, and from a discretionary perspective, give you a return, as we have been able to, of almost 18% net of fees consistently for over 6 years. There really no need for any investor from where I sit to stress themselves by trying to handle a portfolio, which is actually a very sometimes can be a very difficult engagement. So moving forward, we are hoping that we'll see a lot more investors either top up their accounts, and for those who have not invested in Mansa-X, we are looking forward to welcoming you into the Mansa-X community. So once again, thank you very much for believing in us, and we are looking forward to a fruitful conclusion of the year 2024. Thank you.